DeFi. It's one of the major breakthroughs that have come about thanks to crypto. But once you actually start diving into some of the projects that make up the ecosystem, it just seems to get more and more confusing the deeper you go. So stick around and let's talk about it. Hey guys, I'm Sprag, and there's so many advances being made in the crypto space that sometimes it can feel like it's hard to keep up. And for me, one sector that does that is with DeFi. What started as a way for one person to transact with another without the need for a middleman has turned into an entire ecosystem of lending, exchanges, and more, and shows absolutely no sign of slowing down or stopping anytime soon. But firstly, before we get into it, all DeFi protocols are built on top of smart contracts, and if you want to know more about how smart contracts work and the systems that actually go into running a decentralized program on a blockchain, check out my video here. And I've chaptered this video just to make it a bit easier to find the specific DeFi thing that you want to know more about down below. And while you're down there looking at the timeline, if you enjoy my content, please do consider subscribing. So what's wrong with CeFi that DeFi is trying to solve? When it comes to any financial transaction, both parties involved have an incentive to try and make the deal as favorable towards themselves as possible. This is natural and how the bartering system works. The seller decides a price that they would be happy with for their produce, and the buyer decides a price that they would be willing to pay for that item. This means that once the deal goes through, both parties are happy with either what they sold the item for or what they bought the item for. However, as the financial sector has grown, it's become unfeasible to try and actually transact person to person on these larger scales, and therefore new financial institutions have cropped up to facilitate these transactions en masse. But now it's not the buyer and the seller who are coming up with the terms of the agreement for the trade. It's the middleman. The problem is, as I said, they have an incentive to try and make the deal as favorable to themselves as they can. A great example of this is actually the banking sector. Banks want you to store your money with them so they can use your money to offer loans to their other customers. This would be fine if it wasn't for the fact that there is such a discrepancy between loan interest and savings account interest, where sometimes loans can be as high as 9% interest, but you will actually only receive between 0.5% and 1% of that back. This is a bit of a joke when you consider it's your money that is being used by the bank. And this boils down to pretty much the majority of a bank's profits coming from the money they earn off the interest on your money. This is the same for most financial institutions, and unfortunately, due to a lack of financial education, it actually means that a lot of people enter into financial agreements that are really bad for the parties involved, but great for the company that's offering said agreement. You just have to look at how profitable the payday loan industry was, despite offering rates of over 2,000% sometimes, to realize that realistically these institutions are only out to profit one party, themselves. But with over $10 billion locked behind DeFi protocols, let's go into a few different aspects of DeFi and I'll explain how they work. First, we'll start with lending, since it directly relates to what I was just talking about. Traditionally, a middleman is needed to facilitate lending, due to the fact that someone needs to drop the agreement of repayment and interest accrued between the lender and the borrower. However, as is the case with banks, most of the time the lenders don't even know that they are lenders. The money is just available to the middlemen to offer out to borrowers. And funnily enough, this is actually very much the same way that DeFi lending works. DeFi lending uses liquidity pools, which is essentially just a pool of an asset. If there's a large volume of an asset in a pool, then that asset is considered to be liquid. Whereas if there is a small volume of that asset in a pool, it is considered to be illiquid. These liquidity levels are how automatic market makers determine the interest rates for borrowing and lending on those assets. For example, if an asset is very liquid, then it means that the supply is greater than the demand, and therefore the interest rate to supply that asset will be lower because there is not as much demand for that asset. However, if an asset is very illiquid and there's a high demand for it, then interest rates for providing that asset will go up to try and entice people to provide liquidity to that pool. This means that there is absolutely no reason to have a middleman because these rates can be algorithmically determined depending on supply and demand. This, however, doesn't mean that lending doesn't have its risks. It does, in the form of network fees, slippage, and impermanent loss. Network fees are self-explanatory, with the chain of choice for most DeFi projects being Ethereum. But with congestion at an all-time high and ETH 2.0 not coming for at least another year, the cost of transacting on the network is extremely expensive right now. Slippage and impermanent loss are two problems that are just inherent within liquidity pools. Slippage happens when the order placed in a liquidity pool actually causes a price fluctuation in the underlying asset. This means that in placing a large large order, you are actually losing money by placing that order. Impermanent loss, on the other hand, happens when the market price for an asset drops. But this is best explained using an example. Let's say that when ETH is 2000 USDC, we decide to put 1 ETH and 2000 USDC into a liquidity pool. Now, after we've done this, the price of ETH now drops to 1,500 USDC. Because the liquidity pool isn't based on current market prices from the exchanges and is instead determined based on an equilibrium between the two assets, this means that arbitrage traders could go to, say, Coinbase and purchase 1 Ethereum for 1,500 USDC and then sell it to the liquidity pool for 2,000 USDC. This means that while they have made a 500 USDC profit, you have made a 500 USDC loss. This imbalance continues until enough arbitrage traders have rebalanced the equilibrium in the pool. At this point, they would no longer be supplying more Ethereum to the pool because it's no longer profitable for them. This loss is considered to be impermanent because if the price was to go back up and the pool rebalanced, then you technically wouldn't make a loss. However, during this time period, you have lost money. However, to be fair, as the crypto markets become more stable, these sorts of losses will occur less. Lending aggregations are just an extension of the lending platforms, where instead of you, the user, deciding what lending pool you would like to contribute your tokens to, you instead supply your tokens to these aggregation services and they choose the most profitable pool to put your funds into. This means that they do automatic rebalancing of your funds to make sure that you always come out with the highest amount of profit. For example, one of the biggest lending aggregators is Yearn Finance, which automatically rebalances your assets between Aave, Compound, and DYDX. These platforms essentially allow you to make sure that you are getting the highest interest accrual with the most minimal effort on your part. Some of these platforms don't just rebalance among lending platforms, however. Some also include DEXs. This means that you can earn money based on the transaction fees paid by users using those DEXs. Again, these share the same risks as the lending platforms they're actually using. However, they do actually also come with one extra risk, which is that they could be providing liquidity to a riskier pool depending on which aggregation service you use. This means that your funds could be going into a pool that becomes highly illiquid and therefore you cannot get your funds back out again. DEXs work on the same core technology as the lending platforms, where they use liquidity pools to avoid needing a market maker. In a centralized exchange such as Binance, there is an order book which contains all of the buy orders and their price and all of the sell orders and their price. Now, when an order is transacted through Binance, there isn't actually any moving of any funds. There is just a number within their system that says this account now has 1 less BTC and this account now has 1 more BTC. The only time you pay network fees is when you move those funds off of Binance. Let's say that I wanted to buy 1 BTC using Ethereum. I would not pay any fees for sending my Ethereum to the seller, and they would pay no BTC in fees to send me the Bitcoin. This is because there's no actual transferal of funds. It's all just behind the scenes in one large wallet. Unfortunately, this wouldn't work for DEXs, where money actually does transfer from wallet to wallet. This means that if I was to try and buy 1 Bitcoin and it was made up of 20 different transfers, I or the seller would have to pay a transaction fee on every single one of those transactions, making it prohibitively expensive to actually do this automatically. Instead, liquidity pools are used to negate this problem, where there's a transaction fee to put money into the pool, but then the buyer only has to pay 1 transaction fee for the entire sum of their purchase. This fee also does normally include a network transaction fee, which is to reward the liquidity providers themselves. If you want to know more in-depth details about how liquidity pools work, I did go into slightly more detail in my Aave video up here. Providing liquidity to these pools is the core basis behind yield farming. And while I could do an entire video on some of the complex strategies that people go to maximize their yield farming returns, at its absolute most basic, you providing liquidity to either a lending platform or a DEX is how you get started with yield farming and start making passive income on your crypto. However, just remember, the reason that you are getting rewarded for doing so is because there's a risk. If there was no risk, there would be no reward. Crypto derivatives are basically the same thing on-chain as they are off-chain. They are just a representation of a physical asset. For example, there's a current debate going on that stablecoins are actually a derivative, because if you take a $1 stablecoin, it is and always will be worth $1. However, derivatives go much further than just stablecoins, allowing for the tokenization of pretty much any real-world asset, with chains such as Stellar actually being built for that specific purpose. Using synthetics as an example, they offer an extremely wide range of derivatives using oracles to provide their prices. These range from things like currencies to equities like the FTSE 100, Apple stocks, or Tesla stocks, to even things like oil, gold, and silver. The thing is, this is actually an endless growth market where there is no limit to the number of things that could be tokenized and put on chain. This means that we could, in theory, see an entire tokenization of the current stock markets. While DeFi insurance is definitely still very much in its infancy, it is no less important. One major detriment of DeFi is the fact there's no accountability or insurance. If you suffer a loss due to a bug, hack, or any other reason, it is most likely permanent. Because of this, new platforms have been built that allow users to take out insurance against smart contract hacks, bugs, or even stablecoin defaulting. Looking at one of these platforms, Nexus Mutual, which is actually a DeFi protocol which has been given permission by the British Financial Conduct Authority to use the protected word mutual in their name, utilizes risk pools. Nexus Mutual allows anyone to come along and purchase cover and contribute to this risk pool. Insurance quotes on the Nexus Mutual platform are done based on the risk assessments performed by the participants of the risk pool. This means that all of the quotations, claims, and governance is handled entirely by the participants of the risk pool, allowing anyone to receive a payout from this risk pool if something goes wrong on one of the platforms they are insured against. But you didn't think I could just talk positively about DeFi, did you? Just like anything, DeFi has some serious problems that need to be ironed out before the traditional finance sector will start taking it seriously. Firstly, the primary chain that DeFi is built on, Ethereum, is notoriously bad for scalability, and the solution to this, ETH 2.0, is still a year away. Alongside this, there's no guarantee that ETH 2.0 will actually solve the problems, given that it's currently just in its early stages of being developed. And while yes, other chains are being used for DeFi, they do have their own problems, such as low activity. Take Binance Smart Chain. BSC is actually CDFi, which means that while yes, the smart contracts that are running on the chains are decentralized, the chain itself is not. And then this raises the question that if there was enough pressure put on Binance by governments, would they actually halt or remove a smart contract from the network? For me, the solution to this problem is to use something like Anchor. This would allow the scalability to move laterally instead of vertically, letting developers truly go cross-chain and use the power of all of the ecosystem to power DeFi projects. Secondly, code is only as good as the programmers that wrote it. And unfortunately, with so many of these projects being open source, there's nothing to stop a bad actor from poring over every minutia of the code until they find something they can exploit. This, unfortunately, is just a game of cat and mouse, where the community will constantly try to find and patch these exploits before bad actors can use them. The problem is that no codebase will ever be 100% bug-free. And as we've seen in recent months, there have been some big smart contract hacks happening for very reputable chains. This is an issue when you consider accountability. If a smart contract gets hacked and all of the participants lose their funds, who's actually to blame, and how will those participants get their money back? With DeFi, there are no institutions that actually guarantee the funds locked behind these contracts. This means that unlike in the UK, where we have the FCA, which guarantees funds up to £80,000, you would just lose everything if the chain themselves aren't allocating funds for reimbursement. This is the only problem I actually do not think has a solution. Us software engineers are not infallible, and a lot of the time in fixing one bug, we will introduce another. And for this reason, all code can be broken if you spend enough time staring at the code and figuring out how. And the final problem I see with DeFi is regulation. Regulation is actually the number one thing that I think could hurt the DeFi market, because at the end of the day, financial institutions are some of the most profitable companies on the planet, and they have incredible amounts of sway with world governments. And before you take to the comments to say governments can't shut down a decentralized application, you're not wrong. If they raise the bar of entry high enough, it means that your average user will see no benefit in using DeFi over CeFi. When you consider that some governments are now saying that all Bitcoin transactions off exchanges must have user information attached to them, effectively doxing anyone that transacts in Bitcoin, that would be enough to put off your average user from using something like that, where they might not want their information publicly known. When you think of it from the point of view of an average person who has very little crypto knowledge, why would they try to navigate the strict regulation to take out a loan with Aave when they could just take one out with the bank that they are already using, have a rapport and a relationship with? As I said at the start though, there is $10 billion locked behind DeFi smart contracts, which is actually bigger than any single cryptocurrency other than the top 12. This just goes to show how much people believe in DeFi and its money-making capabilities. I hope you guys enjoyed this video. If you did, please leave me a like down below. If you want me to go more in depth into any of the things I've discussed in this video, tell me what it is down in the comments and I'll add it to the video list for the future. And if you just generally enjoy my content, please do consider subscribing. Thanks.